Hello, and welcome back to Private Markets 360, S&P Global's podcast dedicated to enlightening and educating our listeners about the world of private markets from vast vantage points. Your Private Markets 360 co-hosts both sit within market intelligence. I'll start off with introductions. I'm Jocelyn Lewis, head of private debt commercial strategy.
And I'm Jocelyn's co-host, Chris Sparenberg, head of private markets commercial strategy. I'm a super fan of our corner of the investment industry. My background includes time at Cambridge Associates on the portfolio monitoring and benchmarking team, as well as roles in go-to-market at firms like eVestment NASDAQ and Juniper Square. I'm excited to be joining the podcast. We're thrilled to bring our listeners exciting guests every month for discussions about industry trends and other topics of interest here on the podcast.
We sure are, Chris. And if you're interested in regular private markets content, hit subscribe and tune in. Ready to introduce our guest, Chris?
Let's do it. Welcome to Private Markets 360, your insider's guide to the world of private investments. Today, we have the pleasure of speaking with Neil Odom-Haslett, the head of private credit and commercial real estate debt at abrdn Investments. Neil's career spans over 3 decades in the industry, showcasing his expertise in both private credit and commercial real estate debt. Since joining abrdn in 2013, Neil has been a driving force behind their private credit activities. His remarkable journey began at NatWest and continued through prestigious international banks. Neil's expertise is both extensive and deeply impactful. He's played a key role in originating and restructuring private credit transactions across the UK and Europe. Beyond his work at abrdn, Neil has served as the president of the Association of Property Lenders and as an associate of the Institute of Bankers, underscoring his leadership and commitment to the industry. Neil, welcome to Private Markets 360. It's a pleasure to have you today.
Thank you, and I'm really looking forward to our discussion today.
Thank you, Neil. And we are also looking forward to jumping right in here. So let's start off today's discussion with having you share a little bit about your background and your journey into private credit and commercial real estate debt, please.
Yes, well, I started off, and despite my accent, I was actually born in Glasgow, Scotland, but at a fairly early age, migrated southwards to more London. And since then, going through the educational, as everybody does, ended up in the world of banking and working in the City of London. And that journey's been an interesting one for me, from initially starting off in the world of corporate banking, moving over to real estate, infrastructure debt, fund finance, and ending up at abrdn in 2013, as you say, Chris. And it's been a fascinating journey for me, one that every day it's a learning curve for me. It's fascinating to understand how the industry evolves and moves forward.
That's great. And kicking off with the strategy that you're overseeing at abrdn, we'd love to talk about investment grade private credit. Given your experience, can you provide some insight into why an investment grade borrower would choose private credit over more cost-effective public markets financing, despite the illiquidity premium inherent in private credit?
It's an interesting asset class when you come to talk about private credit. Private credit in its simplest form is when a company or asset is financed by a non-bank, and it has very many sleeves within that. It can cover anything from aviation financing, music royalties, ship financing, direct lending, which is the main part of when somebody says private credit. What does that mean? It's mainly direct lending, infrastructure debt, commercial real estate lending, fund financing, and private placements or private corporate debt. Within abrdn, we really focus on the investment grade side of things in commercial real estate lending, fund financing, infrastructure debt, and private corporate debt. And if I was making an elevator pitch to you and saying the pros and cons of private credit, it is very much that they are, in the challenging economic environment that we have and the need for investors to really find the right balance for their strategies and build resilient portfolios. A core part of that is private credit. And it not only does it bring diversification, but it's a differentiator as well. And it's there to complement probably their existing fixed income portfolios. One of its main selling points really is it brings reliable and predictable cash flows. And as I said, abrdn really focus on the investment grade side of it, where all our loans are bespoke, they are structured to protect the downside, and they offer duration from anywhere to 40 years.
That's quite a vast range for a duration. So, I mean, that from just modeling and kind of projecting out needs, both in terms of needs for capital calls as well as returning capital, that's just great to have that kind of insight for such an extensive period of time.
It's probably, when you look at private credit, it's a positive, but it can also be a negative as well, because at the moment, when you look at what's happening in the macro world, is people want liquidity, and private credit, an asset class, is deemed as illiquid. It's not like the public markets. You can't trade the instruments. You really are fixed in for a certain period, which, again, positives and negatives. But generally, when we're looking at what's been happening in the last 2 years or so with rising interest rates, certainly if I look at with my UK lens on it, for a lot of our investors, which come from direct benefit pension schemes and insurers, they're looking to offset their long-term liabilities. And you can get between 4 and 6% returns on a deposit account, which has instant liquidity. So for the last couple of years within private credit, it has been a bit of a challenge in fundraising. However, as interest rates come down a bit, again, there's a different focus from the investor lens. And actually, we do need to offset our liabilities going forward. And also, do you want every single one of your assets to be illiquid? Is that probably the right strategy? Again, there's arguments to and fro, but again, probably sarcastically, that if you want 100% liquidity, you've probably got one or two more issues than thinking about 5% allocation to private credit.
Very true. Very true. And one of the things to think about, there's that risk return spectrum too. So if you think the illiquid assets, then you think that there's this heightened risk sentiment and concerns that some might have about, I've heard potential crisis in private credit. So where do you see the key opportunities and challenges, and particularly at Aberdeen in this investment grade space? How do you navigate the risks and maintain confidence in the growing market of private credit?
It's an interesting question, because as you look across the spectrum of private credit, I think Preqin have quoted $1.5 trillion within the private credit space. Now, throughout that, there's going to be a bit of stress. There's going to be a bit of distress. If you look across that whole spectrum, including the banks, there's going to be a bit of stress and a bit of distress. That happens as economies go from positive to negative, inflation increases, and interest rates rise. But what I will say with that, in defense of the alternate lenders in the private credit space, they have generally retained a very disciplined lending culture. And as a result, mainly as it is asset-backed, yes, there's going to be a few bumps in the road on occasions, but actually it's been pretty robust. And where there has been a bit of stress or distress, it hasn't been all at once. People have been able to manage through that process, which again is a credit to both borrower and investor. It's interesting when I look that the average life of a loan in the private credit space is actually lasts longer than the average marriage. So on the face of it, you'll generally get a few bumps in the road, but it's how you manage those. And with any relationship, there's going to be a few ups and a few downs. But that's the idea, that when you do have and you speak to your borrowers, you build a relationship with them and you try and work through those as best you can. I think I read a stat recently that 42% of marriages end in divorce. If you look at the default rate across the whole of private credit, it's probably less than 1%. So on that way, it's actually probably doing pretty well.
And Neil, turning our attention to asset-backed lending, we've certainly seen heightened, media coverage. I think more managers differentiating themselves for deploying this strategy within the private credit sphere than others. Can you talk about what that means to you and how that reflects on current trends and needs within the private credit market?
Funny enough, I read a report earlier this week that on one day it was saying investment grade in the private credit space is dead. The following day I read, this is where the new growth area is. So it depends which media outlet you look at. And as always, there's always counter arguments. It is, with our investors, what they are looking for is that stable and predictable income flow. And as an investor, as the various market comes back and there's a bit more of a growth phase, they're looking to offset their liabilities, which is a strong position to be in. And certainly from our side, when we're looking at and talking to our investors, yes, it's been a tough couple of years or so, but actually looking forward, there are some seriously green shoots out there as people look to what they regard as more the traditional public side of it and looking in the private credit side of it. Big chunk of it, as I said earlier, is the direct lending side of it. That's a bit more volatile, as we have seen with some, but they're managing through it. And across all the various asset classes, when you think about where is that growth going to come from, fund finance at the moment with a reasonably short duration is quite a new asset class within private credit and with investors, and articulating that the pros and the cons for it is very short term in its nature, generally 2 years. But the uplift you can get above the equivalence rated corporate bonds is you're probably getting up to a 200 basis point increase across the public space. So it's a compelling case for a number of investors.
Yeah, the fund finance space is really interesting that you brought that up, because I feel like it faces scrutiny for people that are looking outside and don't necessarily understand how fund finance works, because they just see, oh, it's leverage on leverage. But I feel as though when you're actually doing fund finance, your LTV ratios, your leverage multiples, they're really attractive. So I think that sometimes private credit gets positioned in that kind of negative light from looking out and just looking at leverage on leverage versus just really look at more of the fundamentals. And you can see that it really is a safe and attractive investment.
Yeah, you're spot on there, really. There is a bit of, I suppose, that people get a bit concerned about when you think, oh, you're putting leverage in a fund, is that's quite scary. But actually, when you dig down in fund finance, essentially, the best way I would usually describe it is like a credit card. You're drawing down on the commitments of the limited partners into a general partner. So you're not getting security over the underlying of the fund, but it's the commitments of those limited partners. And as those draw down, then you get your credit card repaid, and then you go again. So actually, from a treasury perspective, it's incredibly efficient, but it also does boost returns as well. And for us, the gearing seems to be around about 45 or 50%, which I believe is pretty conservative in view of some of the counterparty risk. Look at some of the banks, and their gearings against their shareholding funds can be up to 15 times. So this is way, way, way lower than that. So when you get under the skin of fund finance, actually, it makes more and more sense the way you look at it.
Yeah, absolutely. Switching gears a little bit, but I want to also talk about sourcing and underwriting. And Neil, where are you identifying key opportunities in private credit and commercial real estate? And what criteria guide your decision to move into underwriting once you source a new deal?
When we generally look at deals, we kind of flip the deal back to front, as in, okay, where would you want this loan to be at maturity date, whether that's a 3, 4, 5, 15-year maturity. If it's a longer term, it's generally a build phase, let's say if it's infrastructure, but in commercial real estate lending, because of what has been going on in the world, and there's a very big focus on to carbon emissions and also protecting the environment, we want to make sure the building we're lending against is pretty robust from an ESG perspective. And it ticks all the right boxes from an environment perspective. When people look at the ESG side of things, there's a lot of focus on the E side of it, but also there's the S and the G to look at as well. But greenhouse gases, what you can do to a building to improve its efficiency. So when we start underwriting, we make sure, is it fit for purpose today? But let's say it's a 5-year loan. Is it going to be fit for purpose in 5 years' time? So a lot of our underwriting goes into making sure the building is still relevant. It's still fit for purpose in 5 years' time. And if it's at the moment, if it's not, then we're building structures into the loan to make sure that downside is protected, or putting covenants to ensure that our borrowers, and in all intents and purposes, they're on board with this, because it will protect the value of that real estate as well. But they will also look to look after that building and continue making sure it is working correctly.
Expanding on that and moving into other parts of your deal flow process, as you're assessing current investments or current opportunities, can you give us a sense of where you see red flags, or maybe looking for the potential for red flags to appear in this landscape?
Across all the various asset classes, there's always a danger that once you have raised a fund, is you want to get the money out and deploy the money out as quickly as possible. And sometimes you are got that blink of focus from originator's perspective, get the money out the door quickly. But actually, sometimes you need to step back. So one of the dangers that you have seen when you raise a large fund is deployment, and you chase the market, as the amount of money that's been raised within the private credit space to try and get the money out the door. Are you doing the right deal? Are you doing the right deal for your investors? So chasing the market, it's always a danger. And having that high conviction in your ability to say, actually, just hold back a bit. It's getting a bit too hot in the market. And I think, Dara, so when you get a bit more experience in the market and you can see these peaks and troughs coming through fairly quickly and some of the warning signs. If I go back probably about 3 years or so ago, and at that point, interest rates generally were about 0%, give or take. And the market was still going in the go-go world. It was still chasing the deals. And you kind of step back and thinking, is this actually the real world? Can this be sustained? And you see when buildings are being sold at 2% yields, you think that is a very, very small window in the life of the lending market. So is it time to pull back? When you look at it, 2%, is there really value there? So we and a few others at that point had high conviction saying, actually, the market's getting a bit too hot. It's now time to pull back. So it's having that high conviction. And across Aberdeen, we're very fortunate. We take a generally holistic approach. We do tap into the public markets. We have research. We have a research institute, the real estate equity side of it. So we get to see trends across all the various markets fairly quickly. And as a collective, we make the decision, actually, it's probably in the best intents of our investors just to pull back from the market. Doesn't mean we stop, but it means we actually become a bit more risk off. At the moment, actually, we're more risk on because we actually see things growing and there's a good opportunity because as the peaks and troughs go, we're probably in a bit of a trough in some asset classes at the moment and it's more in a growth period. So it's having that conviction. You just, as we all know, you can look at an Excel spreadsheet and generally you can get it to tell you what you wanted to tell it. But it's not necessarily about an Excel spreadsheet. It is about looking at the fundamentals of each individual transactions. And also the borrower as well. It's important to have the right borrower on board.
Definitely. It's important to have the right borrowers, the research, like you mentioned, and then having that high conviction based on both past trends that you've seen and experience that you have, and then also being able to have that outlook to say, we've seen maybe similar trends before and want to avoid them or at least mitigate the risk, and here's how we're going to do it. Could you maybe expand a little bit and talk a little bit about market surveillance practices that you have in place now to foresee the bumps in the road?
It's interesting that when you structure a loan, you put in loan covenants and they're there as a protection. I think most borrowers usually get a bit spooked at thinking, oh, well, you're going to default us. It's not actually that. It's to bring a seat at the table that when you have particularly forward-looking covenants, it's there just as a reminder thinking, well, if things do start getting a bit tricky, it brings a seat at the table to have that early conversation, which is really, really important. And I remember once saying to one of our research colleagues that the economists are very good at predicting the past, but you can see the trends, but that doesn't necessarily predict the future. So you always have to have that, as we call it, the sense check. Does that actually make sense? And yes, going back to the analogy, there will be bumps in the road, there will be, but it's important to have those proactive conversations before it happens. When it's happened, it's usually too late to sort it out because it's gone too far down the road. But again, with that relationship basis, you should have maybe quarterly, half-yearly chats, or even certainly annual chats with your borrowers, seeing, okay, how things are going. Is it going in the right direction? We see it on this basis. How do you see it? And just to make sure that you have that ongoing dialogue so you can anticipate the situations and then hopefully you'll be able to remediate it.
On that topic of forecasting the past, can you tell us about how all this market surveillance, your experience, kind of the combined expertise within Aberdeen is shaping your thinking on the state of the current market and maybe a little bit into where it's going in the future?
There's quite a few events coming up soon. Like in the US, you have your election coming up. The UK had their election recently. And the old expression, when America sneezes, the rest of the world catches a cold. So there's a lot of focus what's going to happen in the US and who's going to get into the seat of government there. And that will certainly shape what's going to happen in the next 1 or 2 years or so. But we as a house, actually, we sat down earlier this week to say, where do we see the trends going and how can you anticipate that and where is our risk strategy? Are we risk on or risk off? As mentioned, we are a bit risk on at the moment because we actually see growth globally going in the right direction. Yes, there's always pockets. There's always going to be pockets where that's not quite right. But overall, we're pretty bullish. And with our over-surveillance, again, with the global outlook, it's important just not live in your little silo, but to embrace that collaboration across your organization and across the various talents that you have against you around the organization to make sure that actually, if they're seeing trends, whether it is in Asia Pac, US, Europe, or wherever it is, you all take that on board. If I look at a specific asset class, looking at real estate, the UK were hit particularly hard. We had a disastrous budget in September 22, where all things went wrong very, very, very quickly in a short space of time. Interest rates rose, and there was a correction in real estate values very, very quickly. So in the UK, for once, we seem to be ahead of the game, probably in a negative way, because values corrected very, very quickly. But we're now coming out of that. Europe then hooked onto that. They're a bit behind us. And then the US. So all of us have seemed to have gone through that pain and all seem to be a bit in the growth stage. But again, working with your network across the globe, you can pick up signs pretty early about what's going to happen. And again, the way that the government set policy, there's always an eye open to about what ifs, the what ifs. If this happens, if that happens, if interest rates all of a sudden do start going up, what is the impact? And again, it's pretty good to try and interpret that and assess it. What is the impact across the various asset class and indeed across Aberdeen as an investment house?
And Neil, taking that one step further, when thinking about investor sentiment, fundraising, fund structuring, when you're chatting with existing investors, what are they looking for from you? How do you work with them? So if you're maybe raising a new fund or engaging with potential investors or consultants, how are you positioning abrdn to showcase kind of everything that you're doing and really highlight the strengths of what you bring to the table?
With investors, as we always know, they want the highest return for the smallest risk. It doesn't always work that way. As we see, the higher up the risk curve, you generally get the higher returns. So it is trying to speak to, first and find out, we are generally client-led and we want to understand what the clients are looking for. And then we can try and find solutions for them and saying, okay, well, if I'm looking for, let's say, a 7 or 8% return, actually probably investment grade is the place for you. If you're looking for higher double digits, then it's something a bit more of the high yield stuff, not necessarily in the investment grade space. And if you're looking for short duration, medium duration, or longer term duration, we will have solutions for them. So it's important to listen to the investor and what they're looking for, and then we can work with them to try and find the solutions that work for them. And it's important that we work a lot with insurers, and we have what we call the 3 R's, which is it's the regulatory framework, understanding how the regulatory framework works with that individual jurisdiction. Reporting is very, very important for our insurers, and also ratings and your ratings methodologies to make sure that if you do rate a loan, there's no surprises down the road for them if they do it independently. So those are really, really important, and they're very, very key for insurance, particularly in matching adjustment eligibility. Certainly in investment grade, the worst thing they want to do is a loan to become sub-investment grade. That's not a good place for their capital requirements. So it's really important to sit down with the investor, understand what they're looking for, their profile, and then we can come up collectively with a solution for them.
And when you're coming up with that solution for investors, are there different types of investment structures that you're offering, or are there certain investment structures that are kind of most common and that you would use in order to satisfy a large number of investors?
We have several strategies to try and help them along this journey. So the simplest form is where you have a non-discretionary mandate. So all your decision makers effectively, you act as almost like an agent offering the transactions. You'll do initial due diligence for them, and they're saying, we think this makes sense for you, but ultimately they have the right to veto on that. Then there are other funds where they are discretionary, and that is where we make decisions on their behalf with an agreed parameters within that structure. We also have pooled mandates, which can have various different strategies in that. Some with liquidity, some without liquidity. Some have got a 7-year hold-in, but some we have liquidity windows every 6 months or so. So there's a whole range of solutions we can find for them. But I'd say overall, it is making sure that the solution is the one that fits. And again, making sure they have the liquidity they want it, but if not, it goes into a non-liquid fund.
And could you tell us about the yield component and overall return factors of your investments, especially in an environment where private equity, for instance, is facing additional scrutiny on slowness of deals, how much capital is being held and how many unrealized assets are on some portfolios? How do you differentiate there, and how do you really think about yield as being that critical factor?
Ultimately, the investors want to return. They want their capital to work and to get the right yield. Private equity has been a fascinating area. There's a lot of focus on renewables. That's quite a competitive market at the moment. There is one fascinating story that our equity team have done recently, and when they talked me through the transaction, it is a biomethane plant in Italy where food waste goes into this recycling. They recycle the food waste, extract the CO2, liquefy it, and then see those CO2 to beer manufacturers and soft drinks manufacturers for your fizz in your drinks. And it's just a fascinating process how they do it. Things like that. And again, you look at renewables, whether it's wind, hydro, there's a lot of competition and there's usually quite a long lead-in time because a lot of these things will have to be built from scratch. And so, yes, there's a bit more higher risk on the private equity side of it. So like a lot of these strategies, I think the best way to describe it, it is deemed as patient capital. So sometimes you do have to be patient when things are being built and they're coming through to fruition. But again, with private equity, some of the transactions can be 20, 30 years or so before you actually see fruition and the deal's coming through, notwithstanding they'll pay a regular coupon.
And Neil, how does ESG factor into your investment thesis as the market landscape evolves?
All our investment process, there is ESG is integrated into it. And we have, the best way to describe it is that we have a number of criteria that when we look at ESG, whether it is what is the carbon emissions of that building, the pollution side effects, the energy efficiency of it, deforestation, biodiversity, water management, flooding. Then you look on the social side of it, and it's consideration to all stakeholders, employee engagement, the diversity, equity, and inclusion, impact on local community. And then you look at the G side of it, which is the integrity of the company, the internal audit side, bribery, corruption, and so on and so forth. So all these aspects will fill into all our investment and underwriting criteria. And we have a team totally dedicated to this to make sure that there aren't any shortcuts. And if, let's for example, we get the answers that are the correct answers, we make sure that vigilance is ongoing throughout the life of the loan. And we will sometimes build in what we call KPIs, key performance indicators within loans, that if you achieve certain criteria and certain improvements in that building, we could reduce the spread. So it's a win-win from all sides, from the investor side and the borrower side, that actually from the ESG perspective, we are improving the outcomes. There is a big focus on 2050 and net carbon zero, probably quite a way to go on that. But we as a company, we are very much committed to that. So totally within our underwriting is a fundamental part of what we do and how we underwrite a transaction.
That all makes sense. I think underwriting, looking at those metrics and really kind of monitoring them as you're in the investment and over the life of the investment makes a lot of sense. So, Neil, thank you so much for joining us today on Private Markets 360. We really appreciated chatting with you and exploring the insights and strategies shaping the world of private credit and commercial real estate debt. Your expertise on navigating opportunities and challenges in the market highlighted the critical role of asset-based lending, the demand for investment-grade private credit, and offered a look into how ESG considerations are integrated into investment strategies. So you provided some great context for underwriting, fundraising, and engaging with investors, especially in the setting of evolving market dynamics. So thank you so much again for joining us, and we wish you and abrdn continued success.
Thank you very much, Jocelyn and Chris. It's been an absolute pleasure.
Thank you, Neil. Thank you again to our wonderful guest for a great chat today. We really appreciate everyone listening in. If you're looking for more private markets content, hit subscribe to catch future episodes and listen to our earlier episodes wherever you listen to podcasts. Cheers, everyone.
Thank you so much. You can also subscribe to our monthly Private Markets 360 newsletter. The link is in each episode bio, or connect with us on LinkedIn. Have a great day.